Welcome back. The macroeconomic news is relatively thin on the ground in the coming week. You may be pleased to know that the first policy pronouncements from the US Federal Reserve and the Bank of England aren't actually due until the 1st and 2nd of February respectively. However, there is one item that could be noteworthy in the coming week, and that's the latest US inflation report, and that's due on Wednesday the 11th of January. Inflation was one of the biggest macro themes in 2022, and it's likely to remain so in 2023. Last year, the questions were how high could it go and would it peak? Right now, for this year, stock and bond markets, as well as central bankers and politicians, well, they're looking for the rate of inflation to slow down and start to head back toward policymakers' 2% target. If inflation does slow, then the view is that central banks will get to pause on rate rises and then pivot to rate cuts, and that could in turn benefit bond and share prices. That's the theory. We shall see. But it does seem perfectly possible that the rate of inflation slows in the first half of this year, because inflation readings are compiled as an index, and the base for comparison, well, they're pretty stiff in the early stages of the year, given that inflation was gathering pace pretty quickly at this time last year. In addition, oil's no higher or even a bit lower than it was a year ago. Both help and could feed the narrative that US inflation has peaked. Remember, the last reading on the Consumer Price Index was a year-on-year growth rate of 7.1% for November. That was down from June's peak of 9%. However, the real test could come in the second half of this year, when the base for comparison softens. Moreover, wage growth is still strong, and if oil and energy prices go high for any unexpected reason in the second half, the chances of inflation getting back to 2% would look slim indeed, and the heat would be back on central bankers, as they then face the risk of cutting rates and jumpstarting the economy too early. This was, lest it be forgotten, what happened in the 1970s on both sides of the Atlantic. Further inflation surges then forced policymakers to jack up interest rates into the mid-teens and beyond, so investors need to keep their guard up and their wits about them, even if the first half of the year sticks to the script and sees a slowdown in the rate of inflation. Back home, the slate of scheduled corporate reports is a pretty busy one, with year-end and festive trading updates dominant. Retailers, recruiters and house builders in particular will be active, but names which may be worthy of further note and further research include the following, although again some of these dates could yet be subject to change. Robert Walters, Games Workshop and Shoe Zone on Tuesday the 10th of January. Sainsbury, Page Group and Grafton on the 11th. Tesco, ASOS, Halfords, Marks & Spencer, Persimmon and Decra on the 12th. And to finish, Taylor Wimpey, MJ Gleeson and Safestore on Friday the 13th of January. Lucky for some. But the company which might just cause the biggest fuss in the week ahead is Whitbread. The FTSE 100 member and owner of the Premier Inn hotel chain and Beefeater bar and block and cookhouse casual dining brands is due to release a third quarter trading update on Thursday the 12th. The shares are down by around a sixth over the past year, perhaps to reflect worries over a slowing economy in its key markets of the UK and Germany, the squeeze on consumers' disposable incomes owing to inflation, and profit forecast downgrades due to higher energy, staff and input costs. Shareholders may well be looking for reassurance on all of those points from Chief Executive Alison Brittain, whose last update this will be before she steps aside after 7 years in charge and hands over to Dominic Paul. In terms of the hard numbers on offer, the headlines to watch are as follows, but do bear in mind that the effects upon the base of lockdowns and the pandemic in the year to March 2022 mean the numbers could be quite volatile. Firstly, total sales growth. Total sales doubled in the first half and were a fifth higher than the pre-pandemic figure of fiscal 2020. Analysts will also look to the mix between accommodation and food and drinks and the respective trends in the UK and Germany. At the first half stage, accommodation was back above 2020 levels in the first half, but food and drink were 5% behind pre-pandemic levels. Then look to like-for-like sales growth, and again, analysts will then dig into the trends by country and operation. Also look at RevPAR, or revenue per available room. This was just over £62 in the UK in the first half and £35 in Germany. The UK was higher than before the pandemic in 2020, Germany lower. Any further comments also will be of interest on cost inflation and efforts to mitigate them. Alison Brittain quantified cost increases as running at 10 to 11% year on year, and she outlined a plan to cut $140 million of costs by 2025 in response. Also look for an update on room openings. the plans to add 1,500 to 2,000 rooms in the UK this year and 2 to 2,500 in Germany, thanks in part to a capital investment budget of between £500 and £550 million. And then finally, the big one, look for any guidance on profits for the year. Whitbread hasn't offered any formal guidance other than to say at the first half stage that it was, and I quote, confident in the full year outlook. Should management give anything more tangible, the current analyst consensus is for sales of £2.5 billion and pre-tax profit of £348 million compared to 1.7 and a statutory profit of £58 million respectively. Note also that management has forecast the early stage German operation could lose between £40 and £50 million in the current fiscal year. Thank you for watching. I hope that 2023 is a happy and prosperous one for you and your families, and I look forward to seeing you again next week.